Hi there, this is Aditya Aluwalia from Finstructor, and we'll continue the review on ESG investing. So, in the second review, we'll talk about the ESG market as more and more firms globally are now claiming to incorporate ESG into their investment processes, and the popularity of ESG is continually growing. So, we'll study a little bit more about the history, the growth, and the challenges to the growth of ESG investing. So in the first few slides, we'll talk about the history of ESG investing. So in 1983, in response to the mounting concern about the depletion of the ozone layer, global warming, and other environmental problems, the United Nations General Assembly convened the World Commission on Environment and Development. And this produced the Brundtland Report and introduced the concept of sustainable development and how it could be achieved. So again, this report laid the foundations of the Rio de Janeiro Earth Summit, also very important, the Rio Summit, and which was held in 1992. And this ultimately led to the creation of the UN Commission on Sustainable Development that same year. So again, it spelled out the role of businesses and industries in sustainable development, and it particularly states, the Rio Declaration states that businesses have a responsibility to ensure that activities within their own operations do not cause harm to the environment as businesses gain their legitimacy through meeting the needs of the society. So this 1992 development and the Rio Summit were particularly important in terms or in significance to ESG investing and the awareness of ESG. We will talk about the very early phases of ESG investing. So the concept dates as far back as investing goes itself. So even the 17th and 18th century, we find that negative screening based investing was being promoted more by religious groups, advising people on what kind of activities they should invest in and what not. And consequently, as time passed, more environmental issues also came to the fore. So one of the first ethical mutual funds based on these religious traditions was the Pioneer Fund of 1928. So it goes so far back. And the more institutionalization, we can say, happened at the height of the Vietnam War in 1971, where Impact's asset management offered an alternative to their investors into investment companies or investment options that are opposed to the production of nuclear and military arms. Again, the late 1970s, this movement, the divestment movement became increasingly globalized through the divestment campaign in protest at the South Africa system of apartheid. So here again, the investors applied Sullivan principles to engage and divest companies where the investee company was required to ensure that all employees, regardless of race, are treated equally and in an integrated environment as a condition of investment. Otherwise, they would divest or sell off the investment. So again, in the beginning, we saw this ESG investing was more of an ethical approach and more to social and ethical factors. And again, as we discussed, after the 1992 Rio Summit, more environmental factors also came into play. Now, in the modern responsible investing, there has been an increased growth in shareholder activism, first of all. So, secondly, there is more widespread consideration of environmental factors. And now there's not just negative screening that you have to avoid these companies, but there's also positive screening. That is, ESG factors are amalgamated or incorporated into the traditional investing framework, which was traditionally only focused on profit and risk-registered return. So again, now responsible investing essentially incorporates financial as well as ESG factors when valuing companies or when deciding on which investments are good or bad. So after the Enron scandal in the early 2000s, there was more focus on corporate governance as well. So alongside environmental and ethical issues, corporate governance was also increasingly gaining prominence in the modern responsible investment. In 2004, the UN is also a very important era, very important year for ESG. The UN Secretary General Kofi Annan wrote to the CEOs of significant financial institutions to take part into an initiative to integrate ESG into global markets. And this produced a report entitled Who Cares Wins and effectively coined the term ESG, which started becoming or started coming more into use after 2004, Jan 2004. So again, it made the case that embedding ESG factors into capital markets makes good business sense, and it leads to more sustainable markets and better outcomes for societies. So again, a lot of the initiatives that we studied in the previous reviews, the UN Environment Program Finance Initiative, etc., were produced after this period. It was also called the Fresh Fields Report, and the principles of responsible investment also came were formed in 2006. So again, recently, we find that climate change has gained particular attention in the eyes of governments, regulators, businesses, and investors. And this was a result of their stern review on climate change, published in 2006, which concluded that climate change is the greatest and widest ranging market failure ever seen, presenting a unique challenge for economies, and it calls for early action. So, if we ignore it, the cost would be equivalent to losing 5% of the global GDP and could be even higher if more extreme risks play out. So again, some of the history on the key eras and the key years wherein ESG particularly took leaps ahead. Again, 2008, the global financial crisis also made us recognize that market pressures may not always result in ideal outcomes for the wider group, and that institutional investors should also look at the extra financial performance, so the performance on ESG metrics, and not just on profit and loss. And that large asset owners or large institutional owners like BlackRock, Fidelity, so on and so forth, are universal owners, and their performance should be tied to markets and economics as a whole. We'll try to see a little bit more about the growth in ESG investing. So one of the most comprehensive reviews is conducted by GSIA, which conducts research in the five major markets, Europe, USA, Japan, Canada, and Australia, New Zealand, every 2 years. So in the most recent report that we have is from 2018, and where it shows that the assets in these five major markets stood at about 31 trillion US dollars, which is a 34% increase in 2 years over 2016. So in all regions except Europe, the market share of sustainable investing has grown, and Europe has essentially come down because Europe has made it more strict as to what qualifies as ESG investing. So everyone now cannot to just to do some basic research or basic additions and claim to be ESG compliant. So because of the stricter definition, the percentage may have come down in Europe, but essentially in the whole world, the market share of sustainable investing as an investment practice is increasing. Europe, which is about 46%, and USA, wherein 39% of the assets are now responsible or sustainable and responsible investing assets. So these two regions form the highest proportion of their invested assets in ESG. The charts just highlight these points that we just discussed. So the growth has been very good across the world, and it continues. So every year, even anecdotally and from whatever research we study, the percentage of assets in ESG is continually growing, and the absolute growth is also very strong. So again, as a percentage within their countries, only Europe has declined for the reason we discussed. But across the world, the proportion of sustainable investing assets relative to the total managed assets is continually going up. Responsible investment assets by strategy and region. So the most popular strategy continues to be the negative or exclusionary screening strategy. And ESG integration or full integration of ESG into the investment process is fast catching up as a strategy. Impact investing, themed investing, corporate and shareholder engagement are other strategies that are common. But yeah, negative screening and ESG integration are the two most popular. And negative screening is the largest strategy used in Europe, whereas ESG integration is the most popular strategy adopted by investors in USA, Canada, Australia, and New Zealand. And corporate engagement and shareholder action can constitute the most popular strategy within Japan. And finally, the global shares of institutional and retail investors. So retail investors are individual investors, whereas the institutionals are investment firms that are managing money. So again, majority of the ESG assets or ESG investing is still done by institutional investors, but even the retail investors proportion in total ESG assets or sustainable investing is going up, which is a positive sign. So it's about 25% now, up from 20% in 2016, the percentage of ESG assets held by retail investors. And as far as which are the asset classes where these ESG funds are being diverted to, so public equities is the largest portion with 51% share, fixed income is the second with 36% share, and real estate, private equity are both 3% each, and the other classes are hedge funds or commodities, infrastructure, and these vehicles wherein sustainable assets or sustainable investing is done. So public equities and fixed income are still the biggest two asset classes where ESG assets are deployed. Next, we'll study the market drivers of ESG and the challenges in ESG integration. So various stakeholders participate in ESG investing through the choices they make or the information they provide. And this is a list of the various stakeholders, asset owners, managers, service providers, policymakers, and we'll study each of them in a lot more detail in the coming slides. But before that, we want to familiarize with some terminology that you might already know. So shareholders are direct equity holders or owners of a firm. So their responsibilities are those of an owner, which is like voting, engagement, stewardship. So shareholders play a very, very critical and very important role. They are the owners of a corporate or a company, and they can play a major role in driving ESG agenda and driving other corporate governance and a return agenda of the company. Investors would be a more generic term. So it can be either retail investors and institutional investors. And investors can be shareholders, but they can also be debt holders or bond holders. So bond holders are not considered as owners of the company. They have just lent money and they would want their money back with some interest. So investors would be a generic term, could be debt or equity. Investment managers would be people or organizations who invest on behalf of clients under an investment mandate that has been agreed upon. And generally, what we would expect is that mandate has some component of ESG and ESG factors and performance on ESG factors within it. Now, a rough explanation of the financial system value chain can be given with the help of this diagram. So generally, asset owners who own the assets can either buy themselves or through outsourcing to fund managers or investment managers, invest in companies. And this investment will normally happen via a stockbroker or an investment broker who will go through an exchange and finally give us an ownership in the company. This is value chain is more relevant for an equity investment. And of course, policymakers would look at this whole value chain and drive policy decisions or create policy decisions for the proper functioning of this value chain. So asset owners are assisted by investment consultants at times, either to make their own investments or to pick an investment manager. And the manager will work with a broker who gives advice and choose investment in a particular company, which is hopefully following good ESG practices through stock exchanges. So again, in the entire value chain or in the entire system, ESG can be well integrated. So the asset owners advance their sustainability agenda or sustainability goals, and which is happening more and more through CIOs, board trustees, portfolio managers. Then again, that will trickle through to the investment managers who will also need to study ESG of the companies they're investing in. Similarly, brokers and consultants will provide better advice and better evaluation of ESG metrics of the corporates as well as the fund managers. And again, policymakers and stock exchanges will also try to develop more products and regulations that are favoring ESG investing. So this is the financial system value chain in general, and ESG can be incorporated within every step as we will study more. So the first stakeholder that we'll focus on is very importantly the asset owner. So the asset owners have the legal ownership of the assets, and they are essentially investing in order to generate a return, or more precisely, generate a risk adjusted return. So that is what the expectation of asset owners is. And of course, if they focus on sustainability, that they don't just focus on financial return, but they also focus on social return, then that expectation should have a trickle through impact on the entire value chain. So let's focus on understanding what an asset owner is. So he's the legal owner of the asset, and they will make owners will make asset allocation decisions based on objectives, capital market outlook, and regulatory and accounting rules. And asset owners can manage assets directly. So they can invest in the stock markets or bond markets or what have you directly, or they can outsource to an investment manager or an asset management firm. Examples include pension funds, insurance companies, banks, sovereign wealth funds, foundations, endowments, family offices, and even individuals themselves are all asset owners, and they can invest through an asset manager or directly. So they can outsource to an asset manager who acts on behalf of a client. They are not the legal owners, and they generally have to follow an investment management agreement or a mandate, and they act as fiduciary to the clients. That is, they act as uh, managers of their clients' wealth, and they have to act in the best interest of the clients in accordance with the mandates that they have been given. Investment advisors or intermediaries provide advice to asset owners, including on how they should allocate their assets within asset classes or how they should select the investment managers. They help conducting due diligence of managers and products. So investment consultants, investment advisors, financial advisors are all intermediaries that provide investment advice. Now, it's very important. Asset owners are a very important part of the value chain, if not the most important. And they set the tone for the investment value chain. So if they understand well how ESG factors influence financial returns and how their own capital can impact the real economy, then that understanding can significantly drive the amount and quality of ESG investing that happens in the entire value chain. So if the asset owners mandate the managers or mandate the corporates that they are investing in directly to focus more on ESG factors, that is sustainable and responsible factors to the climate and to the society in general, then everyone in the value chain will be incentivized to work more in that direction. So the approach that each asset owner takes and how meaningful they are in driving the ESG agenda will depend on whether they're investing directly or via an external investment manager that they have hired, and whether they are working on their own account. So a foundation or an endowment can be investing their own money, or they are acting on behalf of beneficiaries. So a pension fund may have beneficiaries on behalf of whom they are investing assets. So again, whether they are investing directly and whether they're managing their own money or they're managing a beneficiary's money will have some influence on how they drive ESG policies. So again, directly and out of their own account, they can have a higher say because they don't really have to worry so much about the particular concerns of the beneficiaries. Um, and also the effectiveness of asset owners in general in steering the integration of ESG will depend on how many asset owners are implementing responsible investment, how much AUM do these people have or these owners have, and how much of that AUM is invested in a responsible manner, and the quality of implementation of this responsible agenda across different asset classes. So if an asset owner is focused on ESG factors, then this will generally create a multiplier effect throughout the market. So effective implementation will signify that the responsible investment is a priority, and this will again influence the willingness of consultants, investment managers to focus more on responsible investment. And again, by implementing their commitments, these owners can accelerate the development of responsible investment investing throughout the value chain or throughout the investment chain. So Very importantly, these asset owners or institutional asset owners specifically establish contracts known as mandates with the fund manager or asset managers. Now, it's very important that they define the expectations around their investment product and around their returns within these mandates or within these guidelines that they're giving to the fund managers so that the manager knows that ESG is a priority for this asset owner or ESG investing has to be taken into consideration. So it's good that the asset owner makes it clear within the investment mandate. What we are finding is that a large majority of the asset owner signatories of the PRI that we studied in the first review are now requiring that asset managers act in accordance with the responsible investment policy of the asset owner. So 91% of the asset owners now want their fund managers or the outsourced investment managers to act responsibly. Plenty and 65% also require them to report on this metric. So again, this is 2015, but this requirement is only increasing as time is passing. What are some of the challenges faced by asset owners in driving the ESG agenda? So first is a hesitancy on the part of consultants and retail financial advisors to integrate ESG into their offerings or to assess the ESG characteristics of all funds. So the options left with asset owners are relatively fewer. And again, this puts them at a handicap. So if they want ESG related products, at the moment, there might not be sufficient options available. Again, a lot of the owners also feel that they don't have themselves the scale or capacity to influence the products offered by fund managers and the manager's interpretation of fiduciary duty. So it's important that the fund managers that they're picking do really feel a sense of looking at ESG and have ESG concerns as a part of their fiduciary duty. But if they don't feel so, if they just want to focus on reported profits and not really the impact on environment, then the asset owners will not be able to influence them or will not be able to satisfy their own responsible investing criteria. So that's another challenge that owners feel they cannot really influence the fund managers much. Owners are also unsure on how to integrate the ESG within these mandates that we talked about earlier. That is within the request for proposal or investment mandates that they're giving to. So what exactly should be the metric or how exactly should they define ESG is still not very clear. And finally, smaller asset owners may feel they have limited resources to conduct their own ESG assessment of the managers of their funds. So these are some of the challenges that is faced by the asset owners. And we'll now take a look at some of the major asset owners in more detail. The first category of asset owners that we'll focus on are the pension funds. So of the 100 largest asset owners, we note that 59% are pension funds. So for their size, as well as, and very importantly, the long-term nature of their investment, pension funds play a key role in influencing the investment market and the ESG factors related to investing, or the incorporation of ESG factors in investing. So they're responsible for the management of pension savings and payouts to the individuals or the beneficiaries. So because of the long-term nature of the liabilities, so the pensions have to be paid out over a longer period of time. The ESG factors, climate change, sustainability, which are also more long-term in nature, are particularly relevant to pension funds. So a pension fund is generally set up with the three internal players, and we'll explain that better with the help. So the pension fund will generally be getting contributions from the employers. So the employer will take a part of the employee's salary and deposit it in the pension fund. And the fund would be managed by its own executives or fund managers or people who have day-to-day responsibilities. So the executives will manage this money that is coming from the employer, and they have to pay out the eventual liabilities or eventual pensions to the beneficiaries, or you can say the members of the pension plan. So the employer will take a part of the beneficiary's salary today so that he can earn a pension in the future. So this pension fund will have a board, will have committee or individuals known as the trustees. So the trustees are similar to the board of a corporate. So their responsibility is to make sure that these executives are working or are investing the assets in line to meet the liabilities or the requirements of the beneficiaries when they become due. So if the fund doesn't invest properly, the fund may not have sufficient money to pay back its pensions or pay its beneficiaries. So the trustees are like a board, or the board of trustees makes sure that the executives or the fund is managed in accordance with the requirements of the beneficiaries and is able to pay out its pensions. And of course, climate change and sustainability and ESG factors impact the beneficiaries, they impact the whole society. So the trustees are also expected to make sure that these funds assets which are contributed by the employer, we call them contributions, are invested in an ESG consistent manner as well for the long-term benefit of the beneficiaries. So the fund will have executives who manage, trustees who have the ultimate fiduciary responsibility, that is, they manage the money on behalf of the beneficiaries. So they have to guide these executives in the right direction. So they work separately from the employer and hold assets and trust for the beneficiaries of the scheme. So essentially, these trustees are you can say the de facto owners of this assets that these executives are managing. And the beneficiaries are who pay into the fund and are pensioners benefiting from the assets. So this is the broad structure of a pension fund. Now, similar to the board of a company, the board of trustees, as we discussed, is responsible for ensuring that the scheme is run properly. And again, the beneficiaries may not generally be aware of what exactly the investment decisions the executives are making on a day-to-day basis, but they can or they are increasingly they are being seen to influence the investment decisions or engaging with the pensions to understand where the investments are going and whether they are being invested in an ESG efficient manner or ESG compliant manner. So federal and state governments, please note, are also often amongst the largest institutional investors through their pension funds. So government pensions or sovereign wealth funds are also increasingly aligning their policy intent with their own direct investment influence and adding more ESG integration in their investment activities. So that is the structure of a pension fund. And generally speaking, long-term investing is very relevant and a characteristic of pension funds. But we see that more and more investors in the entire value chain, including pension funds, and very importantly, pension funds, are recognizing the shortfalls of short-termism in investment practice. So short-termism is essentially where investors are basing their investment decisions on short-term momentum and price movements and disproportionately focus on things like quarterly returns and short-term returns. And what this does is that it makes companies and corporates less willing to take on long-term projects such as research and development or projects that will not contribute to a lot of profit in the short run. For instance, adding a waste heat recovery plant or some sustainable renewable plant, because they may take a longer time to show credible results or have a significant financial impact. So if investors are focused on short-term goals, then the companies that they're investing in will also focus on short-term goals. So again, and has been confirmed by various reviews that this makes the economy less productive. It promotes bubbles, promotes financial instability, this short-term attitude. And again, because of this short-term approach, people ignore long-term factors such as ESG factors. So again, more and more regulation is requiring investors to be active owners with a more long-term focus. And this is very relevant to the section on pension funds because pension funds, because of their long-term liabilities, are very well aligned to benefit from long-term investing, and they can create a problem by rewarding managers for short-term behavior. So again, more and more pension funds are integrating long-termism into their investment belief statements, and the requirement to consider ESG factors within investment mandates also reinforces the owner's appreciation for the link between ESG factors and long-term returns. So, because pension funds want long-term returns, they're focusing more on ESG factors because they know that in the long run, companies with good ESG practices and good ESG integration will do better. So it will drive higher long-term financial returns as well. So increasingly, more pension funds and more investors are focused on long-term returns and hence focusing more on ESG integration. And there are various case studies where pension funds have incorporated ESG or incorporated long-term returns in their investment mandates or in their investment strategies. You can go through them. Um, so that we know that these funds, which we studied 59% of the top 100 managers are pension funds. So if they drive towards sustainability goals or ESG practices, and the whole value chain, investment managers below them, consultants, brokers, everyone will drive ESG or incorporate ESG and provide more services related to ESG. Once again, pension fund trustees, as we discussed, are the fiduciaries. So they are managing or they are responsible or they are owners of the funds on behalf of the beneficiaries, and they have a responsibility to act in the best interests of the beneficiaries. So again, the regulation regarding fiduciary duty is what drives their roles and responsibilities, and hence the interpretation of fiduciary duty is very important. So if the trustees feel that ESG is not a part of fiduciary duty, their duty is just to give a financial return, then they will not incorporate ESG. But if they feel that ESG is a part of their fiduciary duty, and then they will drive it in their funds policies and processes. And we just want to highlight that there is a risk of litigation. So if the pension fund trustees ignore ESG, then they may be taken into court because these ESG factors can have long-term financial impact or long-term, or they may create losses in the future. And because the pension fund trustees never focused on these climate factors, they may be held responsible from this loss emerging from ESG related factors like climate change and other social issues. So more and more we are seeing that to be in conformance with fiduciary duties, trustees are required to incorporate ESG factors into their work into their mandates. Again, there is an example of a case in Australia that you can go through wherein a litigation against the trustees took place. Finally, the beneficiaries or the members, people who are contributing funds today, or maybe their employers are contributing funds today. So you can contribute yourself or your employer can contribute, but basically you're working today to receive a pension in the future. So they may not be investment professionals themselves, but increasingly they can drive investment decisions by they may communicate or they may ask the fund managers to incorporate their interests such as ethical preferences and ESG related factors so that the fund manager is more inclined or is also required to fine tune their sustainable investment policies. So again, there are some case studies, for instance, of a Dutch pension fund, wherein the members' survey gave or indicated a strong preference for investments in sustainable energy and other ESG-related factors. And the next category of asset owners we look at are insurance companies. So insurance is divided into property and casualty. So this is insurance from liabilities and damages to property generally, from fire, calamities, etc. Life insurance will cover life losses resulting from loss of life of the insured, and often retirement solutions are also clubbed under life insurance solutions. Reinsurance provides insurance to an insurer, so sharing a portion of an insurer's risk against the payment of some premium to the reinsurer. So Insurers by nature are sensitive to certain aspects of ESG due to the factors that impact their own products, such as the frequency and strength of extreme weather events will impact property and casualty companies, because if these extreme weather events happen more regularly, then there will be more damages to property and more payouts for the insurance company. Similarly, demographic changes will impact life insurance companies and their retirement products that they're offering. So the life expectancy of people and related aspects will drive the premium or the payouts that they have to make in the case of loss of life or in the case of disability, so on and so forth. So this has contributed to many insurers having developed a very advanced understanding around these ESG issues, and many have internal asset management businesses that invest their insurance premiums that they get from the customers. So more and more of insurance companies are advancing their understanding of ESG issues and incorporating ESG factors into their own investing. And we present one case study of Munich Re, which is a reinsurer and is feeling the repercussions of climate change on its business model, and now has a very advanced understanding of the ESG factors, which is impacting the pricing of its reinsurance products, for instance. So yeah, there are more case studies on how insurance companies as asset owners from the premiums they collect can drive ESG investing. The third class of asset owners that we'll study are sovereign wealth funds, and these are also very big investors in the markets today. And this is sovereign wealth is wealth managed through a state-owned investment fund, ADIA, the Abu Dhabi Investment Authority, for instance. Similarly, other countries also have their own sovereign wealth funds. And this is usually a large amount of capital is invested through funds, and the global volume of assets managed by sovereign wealth funds is estimated to be about 8 trillion in 2020. So often the wealth comes from the state's capital surpluses, and these funds are often mandated with the mid to long term objectives of their state, which may often go beyond just optimizing financial return and include broader objectives like economic stabilization, securing wealth for future generations, strategic development of the state's territory, and other objectives. So these objectives don't necessarily have to align with ESG concerns, but more and more we are seeing through the mandates and through the actions of sovereign wealth funds that there is evidence that the wealth funds take ESG factors into consideration in their asset allocation and investor engagement in listed equities. So yes, this is another class of asset owner, a large category, and if they also focus towards ESG, it'll be good for ESG investing as a whole. The other two types of funds that we'll mention are endowment funds and foundations. So endowment funds are generally set up by institutions. So it will be set up by a university or by a hospital. And this fund is expected to fund their own ongoing operations from the withdrawals of the fund. So this fund is invested, and the dividend income or the interest income from this fund will generally be used to meet the salaries and the expenses of the hospital, or the salaries of the teaching staff and the operational expenses of universities, so on and so forth. So generally, these endowment funds are set up to fund these good societal causes like education, hospital, library, for instance. So again, there is some debate that the investments should also be in companies that show good ESG characteristics. And some examples can be found in UK, where universities are pressured by their students to have more sustainable investments in their endowments. So the university's endowment fund should have more sustainable investments. So again, just want to highlight another class of asset owners and how they invest. And the more they invest in ESG, the better it is for the ESG investment industry. Again, the foundations and public charities. So foundations, again, are generally set up to fund some charitable cause, and private foundations have their capital through one funder, typically a family or a business, and public charities originate their capital through publicly collected funds. And again, these companies can have ESG exposures through their investments, as well as ESG objectives through their charitable work that they're doing. Another class of asset owners, endowment funds and foundations. Finally, individual investors are also very big asset owners, and they can also invest their money in an ESG compliant or a non-compliant way. And so individual investors and wealth management industry in general has been a bit slower to transition or to incorporate ESG than institutional investors. So for instance, in the USA, only about 160 billion of the 22 trillion in assets have gone to those referencing ESG at the end of 2018. So it's a much smaller percentage than the institutional investors, where we saw percentages were hitting 30, 40, 50% in various countries. So again, but there's hope. So we are seeing that the inflows in open-ended exchange-traded funds have been increasing, and again, more so for the sustainable funds, and more and more funds are being launched that offer sustainable platforms or which are sustainable funds. So again, the proportion of investment even for retail investors and individual investors, which are a big class of asset owners, is also increasing. And with regards to individual investors, we would like to highlight some generational differences. So what we find is that millennials, which are individuals born after 1980, would have reached adulthood in 2000s and would now be in their peak earning capacity in some right, and will also be big inheritors of wealth from the baby boomers in the future. So we find that the millennials are a lot more ESG focused than the older generations. So 90% of the millennials want to direct their allocations to responsible investments. And of the 75% of individual investors who are interested in sustainable investment, the percentage of millennials was higher at 86%. And again, they are more likely to review the ESG impact of their investment holdings, and they are a large demographic, representing 75 million people in USA, and as we mentioned, future recipient of an expected 30 trillion intergenerational wealth transfer through inheritance, as the baby boomers pass away and pass this wealth to the millennials. So again, the expectation is that they could put about 20 trillion to $15 trillion in ESG assets or sustainable investments, which would be double the size of the entire US market today. So again, individual investors also an important class, and the younger investors, more so we are seeing, are focused on ESG related issues. So we'll continue the discussion on the ESG market in the second review. Thank you. See you next time.